Hey guys, this is Darren. Welcome back to the Touch MBA podcast. This week I brought on Nikhil Agarwal from joinjuno.com or Juno, which is an organization that helps students negotiate the best student loan rates possible. And I really love this conversation because Nikhil's super open and forthcoming about how you guys can minimize your MBA student loans. We talk through all the important variables such as loan terms, repayment terms, fixed or variable rates. And Nikhil is, in the middle of all this really. So he has a lot of interesting things to say, especially in this time of volatile interest rates. So I hope all of you who have questions about financing your MBA, listen to this. I think all the important points are covered. The best money is free money, as Nikhil says. So, of course, the first step is to minimize whatever loans you have to take, right? Through scholarships, financial aid, loans from family members, etc. I think this is one of our best episodes. I hope you enjoy it. And remember that at touchmba.com, we're trying to help you make the best MBA investment. So if you need help shortlisting schools or feeling out whether you're competitive at your target schools, you can get free school selection help, profile help, and more at touchmba.com. One last thing. If you have enjoyed the Touch MBA podcast and you like what we're doing, you can support us by signing up to be a Juno member at joinjuno.com/touch. It's at no extra cost to you. And if you sign up through our sign up link with Juno, then you will help support this podcast and all the effort that goes into making it. So please consider, and thank you very much. Now let's get to my talk with Nikhil. Here we go. My next guest is the co-founder of Juno, which negotiates loan rates for large groups of students and families and has helped thousands of students access over $500 million worth of loans at rates and terms that are better than what they could get on their own as a single student. He is also a Harvard MBA. And so I'm really excited to have him on to talk about how you guys can really get the best student loans at the best rates and make that process as easy as possible. So Nikhil Agarwal, welcome to the Touch MBA podcast.
Thank you so much, Darren, for having me. It's a real honor to be here and excited to jump into the discussion.
Yeah, Nikhil, I've been following you a lot. You've been covered by a lot of the MBA publications, and so I'm really thrilled to have you on our show. And maybe my first question is, how did this whole thing come about? Because I know it came about from when you were a student at HBS, right?
That's absolutely right. It was very interesting. I still save the screenshots of the first post I made. It was back then we used GroupMe. And so in GroupMe, there was this chat with, all the admitted students at HBS. And I posted this idea. I was like, hey, would anyone be interested in a group negotiation for student loans, right? And there's that little heart icon in GroupMe. 22 people hit the heart icon, right? And I was like, oh my God, we got to do this, right? So I was like, okay, what am I doing actually, right? Who knows how to execute on something like that? But I created a little Facebook group. About 70 people joined that Facebook group. And then we just went tapping on different banks and saying, hey, are you interested in participating in something like this, right? We put together this little PowerPoint with everyone's credit score and all these details about them and said, look, we're amazing borrowers. Plus, by the way, we're going to Harvard, right? It doesn't hurt. Do you want to give us loans at better rates than you have on your website? And obviously, pretty much everyone said no, right? But Anthony Noto at the time at SoFi, he replied to a cold LinkedIn message and he said, if you get to 500, let's talk, right? I was like, you gave me a target, let's do it, right? So I went back to that Facebook group. I just posted, hey guys, this is what happened. If we can get to 500, I think we can do something, right? Oh my God, it is amazing. I mean, this is the magic of MBA, right? MBA programs. You see this all the time where people come together and really rally behind something. That's exactly what, in 7 days, we were at 700 members. We grew from like 777, right? Like 70 people. 7 days later, we had 700 across like the top 7 MBA programs. And obviously that got attention. We were able to close a deal with a bank, saved each student on average $14,000. And to be honest, we've just rinsed and repeated that every year since then. And now we are at, I think the latest number is like 700 million.
Okay.
Dollars. Yeah.
So, you need to update your LinkedIn profile, man.
yeah.
I'm just giving you a hard time. It's my fault as well. But yes, that's fantastic news.
Yeah.
Oh my gosh. So what inspired you to like get the group discount? I mean, the
Israelis deserve that credit. So I heard about this as a concept in Israel, where it's apparently over there. It's a little bit different, where it's just one bank that is winning the competition every year, right? But there's about 15 students that get together every year in Israel, and they're able to convince this bank to give them phenomenal rates if all 15 students take the loan from that bank. And we were, in my naivety, my background before this was aerospace engineering, right? I have no clue. So in my naivety, I was like, oh, of course that makes sense, right? And the way I first started, I used to walk into bank branches, right? So I literally went to like Key Bank in Seattle at the time, and I would knock, hey, can I speak to I first would go to the teller, and the teller would look at me like, what do I do with you, right? So they would usher me to the branch manager, and the branch manager, if they are polite, they'll hear me out and then tell me to leave, or if they're not polite, they just tell me to leave. So it didn't work out how it works out in Israel, but that's where the idea came from. Yeah.
That's incredible. And that growth, was it like slow at the beginning and then word got out, or has it always been, that big year after year since you started? Because you started it with your co-founder not too long ago, right?
Yeah, 2018 is when the first sort of unofficial, we were called the MBA loan negotiation group back then, right?
Very direct, to the point.
And then in 2019, we sort of became an official company, right? And we did it then. Yeah, and it's exploded, I guess. I would say 2018, we're just testing the waters. 2019, it really captured the attention of a lot of MBA programs, right? That's when I think it became sort of double-digit percentage of MBA students taking a loan through us. 2020, the big change was actually refinancing. That's when I graduated. I had to refinance my loans, and I was like, wait a second, there's an opportunity here, right? So 2020 there was big growth in that. 2021, we continued. We grew to about $20 million a month of refinancing. So there was still continued growth there. And we really solidified our position because we expanded away from just MBA to other grad students. We tested undergrad for the first time, but it was a colossal failure. We were not at all successful in undergrad. Yeah, and it's kind of been steady since then, right? I wouldn't say 2022 was like a big change from 2021. Our undergrad business did grow materially, but it's still a far cry away from the MBA and graduate students that we're able to help.
Got it. So that's good. If anyone listening is thinking about like a master's in management, right? I mean, do you guys do business school loans, or is it as well as other types of graduate school?
Yeah, business school tends to be the biggest. Law school is pretty popular. Typically, we don't do much medical. Usually, federal loans are a better fit for a lot of medical students. A lot of joint degrees we help. Yeah, and then undergrad of course, runs the gamut.
So, I wanted to talk to you, Nikhil, about optimal strategies, for getting the best MBA loan. But before we get there, as well as today's kind of very interesting, some might say stressful interest rate environment, Let me just ask, like, personally, you coming out of HBS, you executed this idea, basically like an MVP, right? Where you got 700 students. And I'm sure you could have, gone into, I don't know what your career goal essay stated you wanted to do, but maybe a more traditional path. But it seems like you decided to jump and start this company. And I'm just curious, like, what are your kind of thoughts coming out of such a prestigious program like HBS, where you can get high paying jobs, and you're like, nope, I'm going to do Juno. I just take, would love to hear
there was so November 2019, right? This is the date I decided. We sent a survey to our members, right? And we were just like asking for feedback, right? And we were looking for all the negative feedback, right? Because we wanted to improve. The only negative feedback that stood out, of course, there was one or two things here and there, but the only pattern was, why did you not do this sooner, right? Like the number one complaint was, why did you not do this sooner? And everyone else responded with a lot of gratitude. And we had 400 responses, right? And even sometimes now I go back and look at those responses to remind ourselves, like, why are we here, right? And I gave that number initially like $14,000, right? I am really shy to put that number out there because there are a bunch of lawsuits that happened years ago, and people don't like talking about savings in this industry. Okay, so that's why we don't put that number out there. But that's the reason we do this, right? If we can deliver, if we can save someone, it's the difference between going to B-school and having to be on a tight budget and not being able to, really enjoy some of the trips or extracurricular activities, and saying, yes, I'll participate in that and I'm not stressed about it, right? And it creates for a very, very good business school experience. And that's kind of why we're in it and why we are so committed to it, is because we really enjoy it. And, yes, I think for the first 3-4 years, not making too much money, you think about it, right? But hey, I have equity in Juno and someday that'll be worth something.
Yes, there you go. Very interesting. Yeah, because I'm sure that's a tough decision for many founders, who want to take their business to the next level coming out of B school, the opportunity costs. So let's talk about those optimal strategies to minimize your MBA student loans. I'm going off a series of pieces that you've written. The ones I saw were at Poets and Quants, which are wonderful, which I'll link to as well for our listeners. But you mentioned a few variables that you feel MBA students should be aware of. Could you just walk us through those variables and maybe the repayment strategies as well, or anything else you think, our listeners should know about?
Absolutely. So I think, everyone has, in the news, etc. cycles, you hear a lot about like mortgages, and everyone has like this one number for a mortgage, right? It is a far, far different world in student loans, right? So with student loans, the first thing to keep in mind is every lender is going to give you different rates, different terms. And I have seen the same person get like 4% at one lender and then get 12% at a different lender. That's how night and day, right? So it's very important to shop around a little bit and see, hey, what are my options? And I'd plug Juno here, right? Now, in terms of loan term, in terms of the terms you see, there's 3 things that most lenders will allow you to customize about a loan. They'll say, hey, you tell me how long do you want to pay back the loan after graduation, right? And it could be anywhere from 5 years to 20 years. The second thing they'll ask you is, how much money do you want to pay back while you're still in school? Do you want to make no payments at all? Or do you want to pay a little bit, or you actually want to start your repayment, full principal and interest payments as soon as you take the loan, right? And then finally, they're going to ask you, do you want a fixed interest rate or a variable interest rate, right? And here are my thoughts on all these for the current year. This is very much 2023 thinking. Yes. 2022 different answers, 2021 different answers. This is 2023. So the first thing I'll say is, the most popular option by far is to take a 10-year loan, right? And the reason people take 10-year loans is because it usually results in a comfortable enough monthly payment after graduation, accounting for 2 years worth of loans. Okay. The reason why you don't extend it to 12, 15, or 20 years is often because the interest rates you're being charged is higher for a 12, 15, or 20 compared to the 10. Now, could you go shorter and get a better interest rate? Yes, you could. But at that point, a lot of people think it's going to impact their future lifestyle, right? They're thinking, oh, this monthly payment is now looking bigger than I'd like, and I might have to choose a different apartment to live in because of that. And they don't want to make that sacrifice, so they say, okay, I'm going to select the 10-year, right? Now, when I say this, I'm really keeping in mind an average borrower who's borrowing about $70,000 per year, right? So they're borrowing 140 through the whole MBA program. Okay, so that's about the loan term. So, but basically what you're trying to do is you're trying to get as short as you are comfortable with, because that's going to optimize the interest rate. The second thing is the repayment plan, right? Again, the interest rate changes based on the repayment plan. The more you're willing to pay while you're in school, the lower the interest rate you can get. And sometimes these shifts can be dramatic, right? So, a fully deferred plan where you make zero payments while you're in school plus 6 more months after graduation, that payment plan is the most popular. I think it's a mistake, because a lot of the people who take that plan could easily take what's called the fixed repayment plan, where you just pay $25 or $50 a month. You get a lower interest rate, but in addition to that, you also get what's called an auto pay discount, another 0.25% reduction while you're in school. And this adds up to save you more than the money you're paying during school. So that's why I generally encourage people to think about that fixed repayment plan. And these, I would say, are, between the two, are generally the only options that make sense for the vast majority of students. The students who select interest only or immediate repayment plans, where they're making very sizable portions of payments while they're in school, usually have a spouse or some side hustle that's giving them an income. There was a friend of mine, he had a business that was still running while he was in B school. I was like, well, okay, sure. Use that to make some payments, right? So and I guess what I'll add is, in that Poets and Quants article you mentioned, we publish our numbers in terms of how many Juno members are doing. And what you'll see is Juno members take a lot of fixed, right? Probably because I say this thing a lot, versus if you ask the average bank, they'll tell you everyone takes a fully deferred. And fixed versus variable. I think this is going to be controversial, I think. For 2023, I am tempted to test out variable.
Ooh.
Here's the conditions that have to be true. So lots of banks are pricing variable correctly right now, right? Which is, they are pricing variable sometimes higher than fixed, right? Which is counterintuitive, but the situation with interest rates right now is, if they're expecting, hey, interest rates might come down, then your variable rate is actually going to be higher than your fixed. It's not been the case for the last 10 years, but that's the situation we are in now. But I suspect there's a bank out there that is mispricing variable, right? They have gotten so used to the fact that their variable has to be less than their fixed, right, that they're just copy pasting the formula from last year, and they're saying, okay, this is our new fixed rate, this is our new variable rate, and it's going to be 1.5% lower than our fixed rate, right? That was the formula last year, not exactly that was how it looked like last year. And I haven't found the bank yet, but I bet there's like a small, there's none of the big banks are making this mistake, right? But I bet there's a smaller lender out there making this mistake. And I'm like, I want to find that lender and let everyone know about it, because that would be a phenomenal rate. Now, of course, if the variable is priced correctly, then maybe take the fixed.
Yeah. Wow. I mean, it's like how does the variable rate interest work, actually? I'm not even clear how that works.
Yeah, absolutely. So there's an index called SOFR, SOFR. It's a new index. It recently replaced an index called LIBOR, LIBOR, right? So what the lenders will do is, and each lender does it a little bit differently, but at some frequency, call it once a year, right, they'll look up the SOFR and they'll say, okay, if the SOFR is X, then your interest rate is now updated to X plus Y, right? So that Y is called the margin, and the Y is what you're really signing off on when you sign the loan documents, right? You're saying, hey, I'm going to pay an interest rate equal to, my index plus this margin. And yeah, I mean, obviously rates have gone up dramatically. So this SOFR has also gone up dramatically. And everyone who signed a variable rate, 2 years ago, they're kind of kicking themselves right now. Of course, plenty of people refinanced out of it, etc., which is one of the strategies I talk about is like, hey, minimize your interest while you're in school, right? Because you're often case you're not making payments or you're not worried about that number, how large that monthly payment is, right? So you can take the 5-year term, which will minimize your interest rate, but you're not making any payments. So you're not worried about that monthly payment impacting your lifestyle until you graduate. And of course, when you get closer to graduation, you refinance into a longer term. Ta-da, you've saved, a bunch of money over the first 2.5 years. Of course, the risk with that is...
that was my next... Yeah, what's the risk?
Right? The risk with that is the rate environment changes like it just did. Oof. In the grand scheme of things, it's okay, right? But your strategy did not work, right? The reason you did this did not play out. So I think one thing to add is there's sort of this marketing number that goes on, right? When you go to like any lender's website, you'll see a number. It'll be like, hey, as low as X%, right? And what we've noticed is at several lenders, the as low as X% number is really low. Then the next number, any other repayment plan, term, whatever you select, right, is much higher, right? So the only reason that number is that low is because it's coming out of the marketing budget. It's not a risk-based price, right? It's lower than your risk-based price because they want to be able to advertise, some really low number. So that's why this trick of like, okay, take the 5-year variable interest rate loan and see if you get an unusually low rate. And if you do, it's worth thinking about if you want to take that for the next 2.5 years until you graduate and have to start making payments, because you're sort of hacking the system by getting this marketing rate, right?
Yes, I see. I mean, that's all I see, right? When I look at student loan rates as low as this. So that's tricky. So you're saying you really need to look beyond that because that's for very specific cases and credit scores and et cetera, right?
Yeah, and the incoming MBA classes are generally very high credit, right? So they often qualify for these.
Okay.
So the median FICO of an incoming MBA student is 780. I would not have expected that. I get a lot of phone calls where folks tell me like, hey, I have a 780 FICO, right? I should be getting the best rate. And I'm like, well, yes, in the general world, but in the MBA world, it's median.
Right. Right. That's crazy. So the variable interest rate, is that updated every year?
Depends on the lender.
It depends on the lender. Okay.
Yeah. So you want to read the fine print, but yearly is not uncommon. Yeah.
Yeah. Got it. So I think you gave us a really good overview of what slider variables you can kind of adjust, right?
Yeah.
I mean, is there anything else? So what I'm hearing from you is shop around, right? That's really important. Think about the loan term, the repayment terms, try to do that as soon as possible to lower the interest rate with auto pay, and then fixed variable that will really depend on your situation. But that's a tough one right now, I'd say.
Yeah.
Yeah. I mean, is there anything you would advise? Like, okay, maybe we can talk about federal versus private loans, because I think that's a big consideration for many MBAs.
Absolutely. High level thoughts. The first thing is get rid of the undergrad mindset, right?
What's that?
The federal undergrad loans are great, right? Generally speaking, the initial money you borrow from the federal government for your undergrad loans, it's really hard to find a better loan in the private market, right? And, we have an undergrad lending program, and we basically say, hey, have you tapped out your federal loans? If you have, come talk to us. If you haven't, go talk to the federal loan first. Right? But in grad school, that changes. When you're coming for your MBA program, the federal loan programs are pretty expensive. Last year, 6.54%, and the first 20,000 you borrow, and then 7.54% for anything above that, plus a 4% origination fee on that amount above 20,000, right? Compared to what Juno members were getting on average, I want to say like 6.2, something like that, right? No origination fee, no prepayment penalties, the same like 10-year fully deferred, very average, non-aggressive repayment plan, right? And, there's variable pricing. So a lot of people get a lot below that also. As low as, right?
Yes, as low as.
I hate to use as low as numbers. That's why I was like medium, right? Medium. Now, I think for an individual student, right, the way to think about it is, okay, there's federal loans, there's private loans. Federal loans have some protections that the private loan industry just does not offer. The first thing is public service loan forgiveness. The second, income-driven repayment plans. Okay. Now, if you're the average MBA making 6 figures plus post-graduation, these features are useless to you, right? You're not going to be able to use them. If you're not going to be able to use them, you don't value them, and then it's a pure cost comparison. If the private is cheaper, which if you're a Juno member, it's virtually guaranteed to be cheaper. Every year since we've started, our cap has been less than the grad plus. So even the borrower that just barely qualifies was still getting less than the grad plus. Then you take the private loan, right? Because it's sort of equal, and based on the cost, the private is cheaper, so you take it. If you are in a situation where, you take me, for example, I went into entrepreneurship, my salary was $60,000, right? Not exactly the salary a lot of people with $150,000 of debt would feel comfortable with. And, I did not take federal loans, but I'm an example of someone who might have taken federal loans, sign up for an income-driven repayment plan, right? And one thing to keep in mind is when you do that, you are signing up for even more cost, right? The total interest over the life of the loan is even larger when you do something like an income-driven repayment plan, and then later on your salary goes up and you pay it off, right? You see all these news articles, it's more undergrad space, but you see these news articles where someone is like, I had a $28,000 balance, I've paid $16,000 of payments, and my balance is now $29,000, right? That's someone on an income-driven repayment. Okay. So that's something, but it's useful because it allows you to maintain, you need food you need money to eat, live, etc. And it allows you to delay those payments. It doesn't cancel your interest. Generally speaking, that's my strategy, right? If you're a student, think about, do I need public service loan forgiveness? Do I need income-driven repayment? If I don't need those two, just compare the two costs and take whatever's cheaper. Yeah.
Pretty much straight up. So let me just ask you to explain the income-driven repayment plans, because I feel like that's a growing industry. At least it seems like it from the outside. Can you just kind of explain how that works for an MBA student?
Absolutely. So in an income-driven repayment plan, right, this is a feature offered by federal loans. So you can try to get qualified for it. And basically you're saying your income is low and you're not able to make the monthly payments on your loan at the standard repayment plan. So the standard repayment plan is a 10-year loan term, and it's fully deferred. So you don't make any payments until after graduation. So you based on your income, they will, and I don't remember the formula, but based on your income, they will come up with a certain number that's your monthly payment. And now this reduced number is what you're paying. And essentially the formula is meant to ensure that you can put a roof over your head, and you can, it's not meant to burden you while you are working towards increasing your income.
Got it. Okay. And that's why the total interest would stack up, right? Because it doesn't change the amount you have to repay. Got it.
Yeah, it doesn't, it doesn't forgive anything. It's just delaying payment And so interest just keeps accruing. And if your payment is such that it's less than the interest that's accruing every month, your balance is growing, right? And that's a tough spot.
Got it. Got it. And so what would you say to MBA students who think they can make more money investing than, the interest rate they're paying? Actually, this is tough these days, but
yeah,
because I that was one of your strategies, right?
100%. That's what I do. I do it even today, even in the current interest rate environment. I mean, my loan is locked in at like 2 point some percent, but those days are gone. But to be honest, I in a higher interest rate environment, there are also opportunities to make more money passively. Okay. Now, this is not a strategy for everyone. I think of it as maximizing my long-term net worth, right? I personally do not, unfortunately, I have a spouse that works, right? She has income. So we are fortunately not in a place where we have to think about our month to month, right? We make enough money that, our month to month expenses are covered. So personally, my belief is if anyone is in a situation where they're not paycheck to paycheck, you need to switch your mentality to how do I maximize my net worth, right? And then when someone gives you a cheap loan, you take it. You take every dollar you can and you go and invest it somewhere else where you can make more money. And for the longest time, back in 2019, when I used to talk to folks, they used to do this and they used to just invest it in stocks. Right? They said, hey, my long-term expectation for this is 7%, 8%. You're giving me a loan 4%. Let's do this. And they would max out the loans. Now it's changed a little bit, right? Now I'm seeing real estate, right? Stuff like that becoming more attractive where, folks are saying, okay, I'm going to max out this loan, even though I don't have to, right? And I'm going to take the money and I'm going to go invest it I'm going to put a down payment on a property, right? And that's how they are getting 10, 11, 12, sometimes 15, 20% returns. And there's multiple ways to do that, right? I recently came across a company, groundfloor.us, and they allow you to invest in debt. So it's like you take a loan, let's say you take a 7% student loan, and then you give that money out at 10% on a mortgage-backed property that someone's trying to flip. It's risky, right? You got to be careful with this stuff. It's not like the reason why someone is paying 10% is because it's risky, right? So you got to be careful. Exactly. But if you're brave enough and more importantly diligent enough in your evaluation of risk, I think it can be a very valuable. It's an arbitrage opportunity, right? It's an arbitrage opportunity.
What advice would you have to our international listeners who are getting loans? Like, what can they do to optimize, right, their savings here?
Yeah, optimization happens when you have choices, right? And that's a
good quote. Yeah.
Part for international students, the choices are limited, and what we understand this year is even more challenging than previous years because the popular sources for international students, right? Prodigy, Empower. I believe I heard, and don't quote me on this, right? I have no, official information here, but I believe I understand that they are reducing the percentage of the cost of attendance that they are funding, right? So international students may be in a situation where 50% gets funded, right? And the other 50% is either a home country loan, right? And that can sometimes, speaking from India perspective, right? Sometimes it can be like 13%. Not to say Prodigy and Empower are that far behind right now in the current rate environment. I haven't checked, in the last few weeks, but even last season, they were already in the, high single digits to low double digits. So they're not that far behind. Yeah. So, this is probably too early to share, but we've been working hard at bringing an option for international students. It's not a done deal yet. I would say we are 70%, sure that this upcoming year we will have an option for international students without a cosigner.
Wow. Good luck. Fingers crossed for that.
Fingers crossed. Yes. Fingers crossed. And to be candid, I don't know if it's going to be cheap, right? Not out of greed, but just, there's no one providing that capital for cheap. The other thing I'd say is find a US cosigner. right? Like make the ask, pay them if you have to, right? Like, maybe some uncle says, oh, I don't want to be a co-signer because it impacts my credit score. Like, okay, I will pay you $5,000, right? It's well worth it for you. Your origination fees alone are $5,000. Instead, give that to your uncle, take a 6%, 7% interest rate, and avoid the 9%, 10, 11% interest rate, right? The other thing I learned is international students are really good at paying back their loans, right?
Are they? I don't know.
So we've spoken to multiple financial aid offices, right? And again, no hard data, but conversations, anecdotal, right? They say, hey, we sometimes back international students. The financial aid office will basically sign an agreement with the lender that says, hey, if this international student defaults, we'll pay it, right? And the only reason they're willing to do that is because they know they're not going to default, right? And I kind of loosely worded exactly what the agreement looks like, but generally speaking, they're on the hook for some money if there's a bunch of defaults. So we know that international students don't default that much, but there is a systematic issue where no one is excited to lend, to international students. Everyone just compete for the domestic students.
Yeah. I don't know. Well, thanks for those tips. In terms of how people could benefit from what you guys have created at Juno, when do they have to sign up for the group bargaining deals that you guys do?
Sooner the better.
There's no deadline, or how does it work?
So the way it works is between, we kick it off around January, right? December, January. Between January and May, we are negotiating with lenders, right? And during this time, what we are showing lenders is that same as spreadsheet that we showed back in 2018, right?
Yeah.
And nowadays, lenders kind of know what to expect from us, right? But what they're looking carefully at is, how is this tracking compared to last year? How is Juno's volume growing, right? And they really want to see it's, better or equal to last year. That's why I really encourage people to join early. So in this negotiation phase, we can put pressure on lenders and say, hey, you should expect 20% more this year because, hey, I have 20% more right now, right? So, it really helps if students join early. That allows us to have a little more leverage in the negotiations with lenders, and ultimately results in better rates for everyone involved. But worst case, even if you join in June, July, right, we can accommodate you for sure. The one thing I'll add that we've been teasing this year, we haven't done in previous years. In previous years, whether you joined in April or whether you joined in July, you got the same deal, right? Means you didn't, the rate you got quoted doesn't matter based on when you joined. What we are trying to do this year is really incentivize people to take action early, right? So we're saying, hey, based on your Juno membership date, your discount might change. So, hey, you were part of the group early. You really helped us negotiate this lower rate. You deserve better rate, right? Everyone is still going to get a better rate than, but yours is going to be a little bit more better. I don't know how to say this.
Yeah.
Correct grammar, but you get the idea, right? We just want to incentivize people doing two things. Number one, referrals. 8 out of 10 people join Juno because they heard from a friend, right? We have to keep that number up because if we go start spending money on marketing, then I have to take a higher fee to cover those costs, and that discount disappears very quickly. And the second thing is, of course, that we need that volume, and we need it early to put not pressure, but leverage in the negotiations.
Yeah. So when you say become a member, what does that mean? Submitting my name, what does that mean? Yeah.
I would call it it's signing up for a mailing list that's really hungry for information, right? So it's name and email, but it's also hey, where do you think you're going to school? If you know, if you don't, that's fine. Your graduation year, academic, we have 3 categories, personal information, name, email, all that. Academic information, where you're going to school. Financial information, We just ask you for your self-reported credit score. We don't do a credit pull. Just like, hey, what do you think your credit score is? By the way, people are really honest. We found it maps really well to what, eventually when they get the credit check, just before taking the loan, it maps really well. And that's kind of it. You put that information in the system, you're put into what's called a negotiation group based on the profile you filled out. And then we'll send you updates as we are negotiating. So, I think 3 weeks ago, we sent an update that said, hey, these 3 lenders are top contenders. We are, negotiating in this way, etc. So you'll get those emails through May, and then June 1st, we'll release the deal. We'll basically say, hey, here's the lender we selected. You can now submit your formal application and borrow. And there's no obligation, right? Like I said, it's kind of sound like signing up to a mailing list. Once the deal comes out, you can then decide, hey, I like it, I'm going to use it, or no, I don't like it, I'll just go use something else.
Yeah. And then, so you guys are able to get like the best rates, right? Doing that.
Yeah. For the last,
I mean, that's kind of your promise, right? As a company.
Yes. Yeah. In fact, last year I was very proud, and we're trying to repeat it this year. We launched what's called a rate match guarantee, right? And basically we said, look, if you find a better rate anywhere else, our lender will match it, and we'll send you a check, right? For like 1% of the loan amount, 2% of the loan amount. We'll just send you a check. And that way, this is sort of the best rate. And even if you find a better rate, it's still in your best interest to come back to us. And the secret is we set up the structure with the lender where if someone submitted a rate match, the lender needs to go back and think about the rates, right? Because we penalize the lender for having to do for our member having to go through that rate match. That way, the whole group kind of benefits, right, from us not having gotten that best rate right off the bat. Yeah.
Love that. I mean, that's a strong promise. So love that very much. I mean, yeah. And I guess just, zooming out a little bit, back to what's happening today. I mean, what are your kind of thoughts? Is there any way in terms of timing, or I don't know, just any other way students can minimize their loans, or did we cover it all pretty much?
I mean, the biggest savings is not taking loans, right? Like, which is thinking about scholarships and asking for more aid. In fact, we're a big proponent. If you get some aid, ask for more, right? If it's a need-based school, make it a need-based argument. If it's a merit-based school, make it a merit-based argument. If you have a competing admission offer from another school, don't be too shy, right? Be polite, but ask for it. Can't beat free money, right? That's so yeah, I think that's one thing to consider. There is, one idea we've been toying with is using Juno's deal from last year, right? So when you sign up on our website today, you'll see a little button which basically says, check out last year's deal, right? And what you can do is you can actually go take a loan using last year's deal for this year. And then when our deal comes out for this year, you can compare them and decide which one you want and cancel the other one if you like the new one better, right? So that's something people can do. I can't predict rates, right?
Yeah. Come on, Nikhil, you can predict rates for everybody. Yeah, that's a tough one.
But, what's the downside? It's your time. It's a hard credit check on your credit report. If you're using a cosigner, hard credit check on your cosigner's credit report. Overall, I would say it's not that much downside for just optionality, right? That's what you're buying yourself. So that's another thing you could do to
yeah. No, this has been wonderful. Thank you for just sharing the kind of blood and guts of your story, but also, diving deep into all these different variables to consider and strategies to consider. This has been a really fun conversation, and I'm sure it'll benefit our audience. Hopefully more people will sign up for Juno. I'll link to you guys as well in our show notes. Yeah, just last question is, even zooming out even further, not talking about loans, just kind of any advice you have for our listeners to make the most out of their MBA experience. That's something we didn't really talk about. I always love asking this question because I feel like it's different depending on where people went, how far out they are from school as well. So yeah, last thoughts there.
I mean, I would say this is what I don't know. I hope no one from the school hears this, right? But I like to think that the most value the school is providing is in bringing a wonderful group of people together, right? And I'm not talking just about the students. It's, of course, students, but the professors, the students, the whole sort of community that you now belong to. The most value add the school has done is that. And now if you want to take advantage of that, you need to spend time with these people, right? Some people do it by partying like crazy, right? That's just how they work. That's how they form their relationships, right? Some people like me, I like to go play some board games, right?
Me too, by the way. So maybe we can be friends, but that's cool. Yeah, board games.
Yeah. So I think the point is just make sure you spend the time with people, hang out with them, get to know them, and don't stress too much about, oh, am I getting the perfect grade, or am I, all of that tends not to matter, right? I think all that matters is, have you taken out the time during these 2 years to get to know the people around you? Gravitate towards the people who are more interesting to you, more aligned with you, right? Form your community and network. And I think the other part is maybe the counter to this advice, right? Is like, personally, right? Sometimes I felt like, oh, I was too involved in Juno. I didn't take all that time to, spend with my classmates, etc. But it's also been incredible to know that I wasn't left behind, right? I think people understood. Anyone and everyone would still take my call, right? And when we meet with reunions and stuff like that, we have a great time. So I think, yes, try to make the most by spending all the time you can with your new friends. But, don't kill yourself over it, because once you're part of the community, you are a part of the community.
That's great, Nikhil. Thank you so much for coming on the show.
Of course. Darren, thank you so much.
Thanks for listening to the Touch MBA podcast. Remember, you can get free school selection help and a profile review at touchmba.com. You can also follow us on LinkedIn and Twitter. Just search for Touch MBA.